why China just moved $8 trillion, and why that single move is enough to collapse America as an economic superpower. $8 trillion, not over decades, not gradually, quietly, methodically, repositioned beneath the surface of global markets while headlines were focused elsewhere. $8 trillion is larger than the entire U.S. annual federal budget, larger than the combined GDP of most advanced economies. And China didn't move it randomly. They moved it with intent. What makes this terrifying isn't the size of the number, it's the pattern behind it. This exact maneuver has happened before. Not once, not twice, 3 times. Same sequence, same stages, same ending. Each time an established power believed it was too large, too central, too essential to be challenged. Each time it was wrong. Right now, America believes the same thing, that the dollar is untouchable, that markets will always absorb the shock, that China needs the U.S. as much as the U.S. needs China, that interdependence guarantees stability. That belief is the trap, because this isn't about trade disputes or tariffs or political posturing. This is about leverage, and leverage follows math, not sentiment. Over the last 2 years, China has quietly restructured roughly $8 trillion across foreign reserves, sovereign holdings, state-owned enterprise investments, trade settlement mechanisms, and strategic assets. The moves weren't announced. There were no press conferences, no warnings, no market shocks. That's intentional. This phase is always quiet. To understand what's happening, you have to stop thinking like an investor and start thinking like an empire. Empires don't collapse because of one dramatic event. They collapse because dependencies are built, leverage accumulates, and then that leverage is weaponized. There's a 4-stage pattern that governs how economic powers fall. It has repeated for centuries across different civilizations, currencies, and political systems. Different names, different technologies, same structure. Stage 1 is deep interdependence. 2 powers become economically entangled. Trade explodes. Supply chains integrate. Capital flows freely. Everyone benefits. Economists declare a new era of stability. Politicians celebrate partnership. Corporations optimize efficiency. Profit margins widen. Consumers get cheaper goods. No one wants conflict because everyone appears to win. America and China completed stage 1 between the 1990s and early 2010s. Manufacturing was outsourced. Technology was transferred. Entire industries relocated. China became the world's factory. America became the world's consumer. The dollar flowed east. Goods flowed west. Corporate profits soared. Chinese wages rose. The relationship looked permanent. It never is. Stage 2 is asymmetric accumulation. One side begins to quietly store leverage while the other grows complacent. The surplus nation saves, the deficit nation borrows. Reserves build on one side, debt builds on the other, power shifts invisibly. Nothing breaks yet, which is why it's ignored. This is where America made its fatal mistake. While U.S. policymakers focused on quarterly growth and asset prices, China accumulated reserves at historic scale. Not just dollars, but gold. Not just trade surpluses, but strategic assets. Not just factories, but control over processing, logistics, and critical inputs. Rare earths, pharmaceuticals, electronics, energy infrastructure, shipping routes. By the time America noticed, the leverage already existed. Stage 3 is strategic repositioning. This is the phase we are in right now. The rising power prepares for separation while maintaining the appearance of cooperation. They diversify reserves, build parallel systems, reduce exposure, secure resources, rewrite trade rules quietly. Nothing dramatic happens yet. Markets stay calm. Commentators dismiss the moves as routine. They always do. China's $8 trillion move belongs to stage 3. It is not a bet. It is not speculation. It is preparation. U.S. Treasury holdings reduced steadily, not dumped. Gold accumulation accelerated quietly through opaque channels. Bilateral currency agreements expanded across Asia, the Middle East, and Latin America. Trade increasingly settled outside the dollar. Alternative payment systems scaled. Strategic stockpiles filled. State-owned enterprises ordered to unwind Western exposure. None of this triggers panic on its own. That's the point. Panic comes later. Stage 4 is the only phase the public ever notices. The controlled demolition. This is when the accumulated dependency is turned into a weapon. Not all at once, not recklessly, precisely. Financial pressure replaces military conflict because it's cheaper, cleaner, and more effective. Markets seize, liquidity evaporates, supply chains fracture, confidence collapses. America believes it can respond when that moment comes. It can't. Because the response window closes before the public realizes the crisis has started. By the time headlines acknowledge what's happening, the damage is already locked in. This has happened before. Britain believed sterling was permanent until it wasn't. Japan believed U.S. markets were immune until 1987. Europe believed energy interdependence guaranteed stability until 2022. Each collapse followed the same structure. Each one was preceded by quiet repositioning that looked harmless at the time. China watched every example, studied every failure, improved the model. The reason this time is more dangerous is scale. America's economy is larger, its financial markets are deeper, its debt is higher, its dependencies are broader, and China's leverage is more comprehensive than any challenger in history. This isn't about ideology or hostility, it's about arithmetic. When one nation holds supply chain dominance, reserve leverage, alternative settlement systems, and strategic stockpiles simultaneously, the outcome becomes predictable. And that brings us to the most important point. The $8 trillion move is already finished. The repositioning phase is nearing completion, which means the only variable left is timing. In the next part, you'll see exactly how this leverage translates into market collapse, not hypothetically, mechanically, step by step. You'll see why America's debt structure turns pressure into crisis, why markets can't absorb the shock, and why the Federal Reserve's tools no longer work the way people assume. The collapse doesn't begin with panic. It begins with silence, and by the time it becomes loud, it's already too late. The moment pressure is applied, America's system doesn't bend. It snaps. That's the part almost everyone misunderstands. People imagine collapse as a slow decline, a long grind, years of adjustment. That's not how financially dominant systems fail. They fail suddenly, not because the fundamentals change overnight, but because confidence does. And confidence is the only thing holding together a system built on debt, leverage, and expectation. America's vulnerability is not weakness. It's size. The larger and more liquid a financial system becomes, the more dependent it is on continuous trust. Markets don't price stability, they assume it. And when that assumption breaks, liquidity disappears faster than policymakers can react. China understands this. That's why the $8 trillion repositioning wasn't designed to shock markets directly. It was designed to remove the shock absorbers first. Start with U.S. government debt. America finances itself through constant refinancing. Trillions roll over every year. This only works if there is always deep demand for treasuries at predictable rates, not just demand from domestic institutions, but from foreign holders who recycle trade surpluses back into U.S. debt. China has been one of the largest of those holders for decades. By slowly reducing treasury exposure instead of dumping it, China avoided triggering yields prematurely. At the same time, it forced other buyers to absorb more issuance. That absorption only works if confidence remains high. Once confidence wavers, the demand curve breaks. That's when interest rates spike. A sudden spike doesn't just increase borrowing costs. It cascades through everything. Mortgage rates, corporate debt, municipal financing, student loans, credit cards, pension liabilities, government interest expense. America's debt structure amplifies this effect. With debt levels this high, even small rate moves have outsized consequences. A 1% increase in average borrowing cost translates into hundreds of billions in additional annual interest payments. There's no buffer for that. So, when pressure arrives, the Federal Reserve faces an impossible choice. Allow rates to rise and trigger a deflationary collapse, or intervene by printing money to cap yields. Either path damages confidence. One causes immediate contraction. The other causes long-term currency erosion. China doesn't need to choose. America does. Now move to supply chains. Decades of optimization turned efficiency into fragility. Just-in-time delivery reduced costs, but eliminated redundancy. Entire industries depend on single regions, single suppliers, single processing hubs. That's not an accident. It's what maximizes margins. China sits at the center of that web. Not just assembly, but upstream control. Chemical precursors for pharmaceuticals, processing of rare earth elements, intermediate components for electronics, specialty manufacturing that can't be replaced quickly. This means disruption doesn't need to be total. It only needs to be targeted. Export delays instead of bans. Regulatory inspections instead of embargoes. Licensing requirements instead of shutdowns. Small frictions that compound across global supply chains. The effect is inflation without obvious blame. Prices rise. Availability drops. Production schedules slip. Companies miss earnings. Markets sell off. Consumers feel pressure before policymakers even agree on what's happening. And here's the critical point. America can't reroute supply chains quickly enough to respond. Building domestic capacity takes years. Environmental approvals, workforce training, capital investment, infrastructure. None of that happens in time once the pressure begins. Markets know this, which brings us to capital flows. America's asset prices are inflated by foreign capital. Equities, real estate, private equity, venture funding. All of it depends on the assumption that the U.S. remains the safest, most liquid destination for global money. When that assumption weakens, capital doesn't trickle out, it rushes. China's directive for state-linked institutions to reduce Western exposure matters because it creates a seller without a buyer. $8 trillion exiting over a defined window is not diversification. It's disengagement. Even if the selling is gradual, markets price the future. Once participants realize that a major holder is structurally exiting, valuations adjust downward, not because of panic, but because demand is permanently reduced. That's how bubbles deflate, not with crashes at first. With repricing, lower multiples, tighter liquidity, higher risk premiums, volatility becomes structural instead of episodic. Retirement portfolios underperform, pension assumptions fail, state budgets tighten. The system becomes brittle. This is where psychology takes over. America's financial dominance rests on belief. Belief that treasuries are risk-free. Belief that the dollar will always hold value. Belief that markets will always recover. Those beliefs are self-reinforcing until they are not. And once foreign actors begin settling trade outside the dollar, the recycling loop weakens. Fewer dollars flow back into U.S. assets. That forces domestic buyers to absorb more issuance. Domestic buyers are more sensitive to rates. Sensitivity accelerates instability. This is why alternative settlement systems matter more than tariffs or sanctions. They don't replace the dollar overnight. They erode it gradually. And gradual erosion is more dangerous than sudden shock because it lulls policymakers into complacency. By the time the effects are visible, they're no longer reversible. This is exactly what happened to previous reserve currencies. Confidence didn't collapse because of one decision. It collapsed because alternatives existed. China's $8 trillion move isn't an attack. It's the removal of dependence. And once dependence is gone, leverage flips. America can't force capital to stay. It can't compel foreign trade to use dollars. It can't rebuild supply chains fast enough to prevent shortages. It can't raise rates without triggering recession. It can't print money without weakening the currency. Every tool has a cost. China has already paid its costs in advance. That's the difference. The danger isn't that China will act recklessly. The danger is that it doesn't need to. Simply continuing the current trajectory tightens the vice. And that brings us to timing. Financial collapses don't announce themselves. They emerge from normal-looking data. Slightly weaker auctions, slightly higher yields, slightly delayed shipments, slightly worse earnings. Then suddenly, everyone notices at once. In the next part, you'll see how this transition from slow pressure to sudden crisis happens. How markets move from denial to repricing to panic. How feedback loops form. And why, once the tipping point is reached, intervention accelerates collapse instead of stopping it. The system doesn't fail because it's attacked. It fails because it's exposed. There is a moment in every financial collapse when the data still looks manageable, but the system has already crossed the line. That moment is defined by feedback loops. Up to this point, pressure accumulates quietly. Yields rise a little. Liquidity thins slightly. Supply chains slow just enough to push prices higher. Investors explain it away. Policymakers call it transitory. Markets adjust, but they don't panic. Then the loops begin to feed on themselves. The first loop forms in the bond market. When large holders reduce exposure, yields rise. Rising yields increase the cost of servicing existing debt. Higher servicing costs widen deficits. Wider deficits require more issuance. More issuance pushes yields higher again. That loop doesn't need a catalyst. Once it starts, it sustains itself. This is where America's size becomes its weakness. The Treasury market is enormous, which means small shifts in demand require massive adjustments in price. There is no marginal buyer large enough to replace a structural seller without consequence. As yields climb, something else breaks: asset valuation models. For over a decade, near zero rates inflated everything: stocks, housing, private equity, venture capital. When the discount rate rises, future cash flows shrink. Valuations compress. What looked safe becomes expensive. What looked stable becomes risky. This is the second loop. Falling asset prices weaken balance sheets. Weakened balance sheets tighten lending. Tighter lending slows growth. Slower growth reduces earnings. Lower earnings justify lower valuations. Markets don't fall because of fear. They fall because math changes, and math always wins. The third loop forms in currency markets. As capital outflows increase and trade settlement shifts away from the dollar, demand for dollars weakens. A weaker dollar raises import prices. Higher import prices feed inflation. Inflation pressures force tighter policy or more intervention. Both responses hurt confidence. Tightening into weakness accelerates recession. Intervention through liquidity. Expansion weakens the currency further. Either path reinforces the loop. This is why reserve currencies don't decline smoothly. They oscillate. Volatility increases. Stability disappears. The fourth loop appears in commodities. China's control over processing and supply gives it the ability to influence prices without cutting off supply. Small restrictions create outsized moves. Higher commodity prices feed producer inflation. Producer inflation passes to consumers. Consumer inflation erodes purchasing power. Households feel it before markets do. When living costs rise faster than wages, consumption slows. Slower consumption hits corporate revenues. Revenues miss expectations. Stocks fall. Retirement accounts decline. This is when the political layer activates. Public pressure rises. Policymakers respond with short-term measures. Price controls, subsidies, emergency spending. Each one increases deficits. Each one adds to issuance. The bond loop tightens again. At this stage, Intervention becomes counterproductive. Markets begin to anticipate policy responses and sell ahead of them. Every announcement accelerates the move it's meant to stop. This is the tipping point. It's also the point where narratives flip. For years, the dominant story is resilience. America always recovers. The system is flexible. Innovation will solve it. When the loops lock in, that story breaks. Not gradually, all at once. Media coverage shifts tone. Analysts stop debating whether something is happening and start debating how bad it will be. Risk models recalibrate. Margin requirements rise. Liquidity evaporates. And then comes the part most people never see coming. Correlation. In stable systems, assets behave differently. Stocks up, bonds down. Growth here, safety there. During systemic stress, everything moves together. Risk becomes binary. Exposure matters more than diversification. Pension funds discover that assumptions no longer hold. Endowments realize their hedges fail when they're needed most. Insurance models break. This is when forced selling begins. Not because investors want to sell, but because they have to. Margin calls, redemptions, collateral requirements, regulatory thresholds. Forced selling creates price-insensitive sellers. Price-insensitive sellers create air pockets. That's how crashes happen. Not from emotion, but from structure. China doesn't need to trigger this directly. It only needs to continue its repositioning while alternatives mature. The existence of those alternatives is enough. Once markets understand that trade can settle without dollars, that payments can clear outside Western systems, that supply chains can be rerouted, the premium on American assets disappears. The premium is what sustained excess valuation. Without it, gravity returns. The Federal Reserve is often seen as the ultimate backstop. But backstops only work when confidence remains. Printing money stabilizes markets only if people believe the currency will retain value. When confidence is the variable under attack, liquidity becomes fuel. More intervention means more dollars chasing fewer real assets. That pushes investors toward hard assets: gold, energy, food, infrastructure, anything tangible. Capital flight doesn't require borders to close. It happens digitally. And as capital moves, political pressure intensifies. Trade partners demand settlement in other currencies. Creditors demand higher yields. Allies hedge exposure quietly. Publicly, cooperation continues. Privately, diversification accelerates. This is the moment when America's leverage disappears. Sanctions lose power when alternatives exist. Diplomacy weakens when markets don't follow. Military strength can't stabilize bond auctions. Power shifts without a single announcement. This phase feels confusing in real time. Data sends mixed signals. Some markets rally on stimulus, others sell on fundamentals. Volatility becomes the norm. People argue about narratives instead of mechanics. That's why collapses are rarely recognized until they're irreversible. By the time unemployment rises meaningfully, the financial damage is done. By the time emergency measures are deployed, capital has already moved. History shows this clearly. The British pound didn't fall because of one decision. It fell because confidence evaporated. Japanese asset bubbles didn't burst because of one trade. They burst because leverage flipped direction. Europe didn't suffer because energy disappeared. It suffered because dependence was weaponized. America is entering the same phase, not because it is weak, but because its system is exposed. The $8 trillion move didn't start this process. It revealed it. And in the next part, you'll see what happens when this pressure collides with real-world events, elections, geopolitical shocks, market accidents, why timing becomes nonlinear, why seemingly small events suddenly have massive impact, and why, once the cascade begins, stopping it becomes impossible. The system doesn't warn you when it crosses the threshold. It only shows you after. Every collapse has a trigger, but the trigger is never the cause. By the time the visible event arrives, the system is already unstable. The spark only reveals the weakness. That's why observers always argue about what caused it and miss why it was inevitable. In this phase, timing stops being linear. Small events produce oversized reactions. Routine data releases move markets violently. Comments that would have been ignored months earlier suddenly carry weight. Confidence, once cracked, becomes hypersensitive. This is where America is most vulnerable. Because the country operates on overlapping calendars, political cycles, earnings seasons, debt auctions, monetary policy meetings, international summits. Any one of them can collide with the pressure already built into the system. An election year amplifies uncertainty. Markets hate uncertainty more than bad news. Policy paralysis becomes visible. Competing promises imply higher spending. Higher spending implies more issuance. More issuance pushes yields higher. The bond loop tightens again. At the same time, geopolitical events stop being isolated. A shipping disruption in one region spills into prices elsewhere. A sanctions announcement triggers currency hedging. A diplomatic dispute prompts quiet trade rerouting. China doesn't need to escalate. It only needs to let events play out while alternatives are available. This is the essence of strategic patience. When stress builds, institutions begin to act defensively. Banks tighten standards. Insurers reprice risk. Clearinghouses raise margin requirements. These are rational responses. Together, they remove liquidity. Liquidity is what turns stress into crisis. Once liquidity dries up, markets gap instead of trade. Prices move without volume. Volatility spikes because there are fewer participants willing to take the other side. This is when policymakers step forward. Emergency facilities are announced. Temporary guarantees are issued. Assurances are given. But the order matters. Markets don't wait to see if measures work. They react to what measures imply. If support is large, it signals danger. If it's small, it signals insufficiency. Either way, confidence erodes. This is why central banks lose control late in cycles. They can add liquidity, but they can't force belief. As belief weakens, behavior changes. Corporations delay investment, households delay spending, employers slow hiring. These choices are defensive, but collectively they slow the economy. Slower growth validates pessimism. The feedback loops reinforce. This is also where international behavior shifts visibly. Trade partners diversify settlement. Central banks add to gold reserves. Sovereign funds rebalance away from U.S. assets quietly. None of this is announced as a break. It's framed as prudence. Prudence at scale looks like retreat. America feels this through markets first, then through budgets. Tax receipts weaken. Social spending rises. Interest expense grows. Deficits widen automatically. Automatic stabilizers become automatic accelerators. This is the paradox of advanced economies. The mechanisms designed to smooth cycles amplify stress when debt is high. As fiscal space narrows, political pressure increases. Calls for intervention grow louder. Blame spreads. Confidence fractures along ideological lines. Markets see division as risk. Risk demands compensation. Yields rise again. At this point, currency dynamics become decisive. A weaker dollar temporarily boosts exports, but it raises import costs. Since America imports essential goods, inflation returns even as growth slows. That combination is toxic. Stagflation erodes trust faster than recession. Households notice, savings lose purchasing power, borrowing costs rise, asset values fall. The promise of stability breaks. This is when narratives flip from optimism to protection. People stop asking how to grow and start asking how to preserve. Capital behaves the same way. Money moves toward assets perceived as insulated from policy risk, tangible assets, jurisdictions with fiscal discipline, systems with lower leverage. This movement doesn't require panic, it requires choice. China's role in this phase is mostly invisible. Its leverage lies in optionality. It can continue trading, continue selling gradually, continue settling bilaterally, continue offering alternatives. Optionality is power. America's problem is the opposite. Its options narrow as stress increases. Raise rates and deepen contraction, cut rates and weaken the currency, expand spending and worsen deficits, tighten spending and slow growth. Each choice has a cost. None restore confidence quickly. The market understands this asymmetry. That understanding shows up in volatility pricing, credit spreads, and currency hedging long before headlines declare a crisis. This is why collapses feel sudden to the public but slow to those watching the plumbing. By the time layoffs rise materially, the market damage is already done. By the time emergency summits convene, capital has already moved. The most dangerous moment is when stabilization appears to work. Temporary rallies convince people the worst is over. Policymakers claim success. Risk returns briefly, but the structural issues remain. Debt still needs refinancing. Supply chains are still fragile. Alternatives still exist. The system resets to a higher stress level. Each cycle leaves it weaker. This is how drawn-out collapses unfold. Not in one crash, but in waves. Each wave reduces resilience. And this is where the final stage approaches. Once enough actors accept that the old order won't fully return, behavior locks in. Contracts are rewritten, reserves reallocated, trade routes rerouted. The shift becomes self-reinforcing. In the final part, you'll see what that lock-in looks like. How the system crosses from instability into a new equilibrium, why wealth doesn't disappear but moves, and why those who understand the pattern early are positioned very differently from those who trust recovery narratives. The collapse doesn't end with chaos. It ends with replacement. Collapse is the wrong word for what happens next. What actually occurs is transfer. When systems break, value doesn't vanish. It moves. It relocates from one structure to another, from one set of assumptions to a different one. The visible pain comes from the speed of that movement and from who is positioned to receive it. This is why the final stage doesn't look like chaos for everyone. It looks like opportunity for a few. Once lock-in occurs, behavior stops oscillating. Markets stop debating whether the old order will return and start pricing the new one. Contracts shift, settlements change, reserves are held differently. Trade routes normalize around alternatives. At that point, reversal becomes impractical. America's financial system was built for dominance. It was optimized for scale, speed, and confidence. Those strengths turn into liabilities when the assumptions underneath them change. The dollar doesn't disappear. It loses priority. Treasuries don't default. They lose privilege. Markets don't shut down. They reprice permanently. That repricing is the wealth transfer. Assets that depended on constant foreign demand reset lower. Assets tied to domestic consumption reprice under pressure. Debt-backed valuations compress. Long-duration growth assumptions shrink. Meanwhile, assets tied to scarcity, production, and neutrality rise in relative terms. Now, this is why history always produces the same pattern of winners and losers. Those who believed stability was guaranteed hold claims on systems that no longer command trust. Those who understood leverage hold assets that function regardless of which system dominates. China's $8 trillion move doesn't force this outcome by itself. It completes the conditions. It removes dependency. It creates optionality. It ensures that when stress arrives, alternatives already exist. That is what makes the transfer orderly rather than explosive. Orderly does not mean painless. For households, the experience is slower but relentless. Purchasing power erodes. Savings underperform. Asset values stagnate while costs rise. The promise that markets always recover on a reasonable timeline no longer holds. For institutions, the shift is more abrupt. Portfolios underperform benchmarks that no longer reflect reality. Hedging models fail. Liquidity assumptions break. Strategies that worked for decades stop working at once. For governments, the constraint becomes real. Debt still rolls, but at a higher cost. Policy choices narrow. Trade-offs become visible. External discipline replaces internal discretion. This is how financial sovereignty fades, not through conquest, but through math. China does not need to replace America everywhere. It only needs to offer enough alternatives for enough participants to change behavior. Once behavior changes, dominance dissolves. The dollar's role as default settlement weakens incrementally. Bilateral trade grows. Regional systems deepen. Risk premiums shift. None of this requires announcements. It shows up in data after it is already true. This is why so many people will insist nothing fundamental has changed, even as outcomes diverge sharply from expectations. Markets can rise in nominal terms while real wealth declines. Wages can grow while purchasing power falls. Indexes can hit highs while households feel poorer. That disconnect is the signature of transition. The United States has navigated transitions before, but never with this combination of debt, dependency, and external alternatives. Previous adjustments were absorbed because there was nowhere else for capital to go. Now there is. That single fact changes everything. China's preparation was not about confrontation. It was about insulation. By securing supply chains, building settlement alternatives, diversifying reserves, and reducing exposure, it ensured that stress would be asymmetric. Asymmetry determines outcomes. When one side must react and the other can wait, the patient side wins. America is not collapsing because it is weak. It is recalibrating because its system no longer sits alone at the center. The world is moving from singular dominance to plural structures. Plurality reduces privilege. That is the cost of transition. Those who expect a return to the previous equilibrium will be disappointed. The system does not snap back. It settles forward. New benchmarks emerge. New trade corridors dominate. New financial centers grow. New rules become normal. This is why timing mattered. Those who recognized the pattern early adjusted gradually. They diversified exposure, reduced dependence on single systems, increased resilience. Those who waited for confirmation will adjust under pressure. And those who deny the shift will absorb the cost. History is consistent on this point. Empires don't announce their decline. Markets don't ring bells. Transitions happen quietly, then suddenly feel obvious. China's $8 trillion move was not a headline event. It was a structural one. The move is complete. The alternatives are built. The leverage is in place. What follows is normalization under a different hierarchy. America remains powerful, innovative, influential, but no longer singular. And singularity is what sustained its financial dominance. The wealth transfer underway is not punitive. It is mechanical. It rewards preparation and penalizes assumption. It favors systems with lower leverage, tangible production, and optionality. It diminishes those built on perpetual inflows and confidence without redundancy. Understanding this does not require pessimism. It requires realism. The final stage is not collapse into darkness. It is adjustment into a new order. Those who see the pattern early don't panic. They reposition. Those who mistake stability for permanence do neither. China's $8 trillion move did not end America. It ended the era in which America's financial system stood alone. What replaces it is already forming, quietly, inevitably.